Most people think turning $10,000 into 100 million requires luck, secret connections, or decades of grinding. I don't see it that way. Markets reward clarity, discipline, and the courage to act when the odds are overwhelmingly in your favor. My journey wasn't about making thousands of trades or chasing every opportunity that appeared on the screen. It was about waiting patiently, understanding the big picture, and then betting aggressively when I knew I was right. The real secret isn't how much you start with, it's how well you protect your capital, how quickly you admit when you're wrong, and how boldly you press your advantage when you're right. The biggest mistake most investors make is believing that success comes from constant activity. They feel the need to always be trading, always chasing the next idea, always reacting to every small movement in the market. It creates the illusion of productivity, but in reality it often leads to mediocre results. The truth is that the greatest opportunities in markets don't appear every day. They appear occasionally, sometimes only a few times a year, and the ability to recognize those moments is what separates extraordinary investors from average ones. Early in my career, I realized that trying to be involved in everything was a losing strategy. Markets are incredibly complex, and no one has the mental bandwidth to deeply understand dozens of opportunities at the same time. If you spread your attention across too many trades, your conviction weakens. You start making decisions based on noise instead of insight. When that happens, your edge disappears. Instead, I learned to narrow my focus dramatically. Rather than searching for hundreds of trades, I searched for a handful of situations where the probability of being right was overwhelmingly high. These situations usually came from deep research, strong macro understanding, and recognizing when the market narrative was about to shift. When you reach that level of clarity, you're no longer guessing. You're positioning yourself where the risk is manageable and the upside is enormous. Patience becomes one of the most powerful advantages an investor can have. Most market participants are impatient. They want action, movement, excitement. That impatience forces them into trades that don't truly deserve their capital. By simply waiting for better opportunities, you automatically avoid many of the mistakes that destroy portfolios. When you concentrate your capital on a few high-conviction ideas, something interesting happens. Your thinking becomes sharper. You analyze every detail because the stakes are meaningful. You understand the macro forces driving the opportunity, the psychology of the market participants involved, and the potential catalysts that could cause a dramatic move. That level of focus transforms investing from speculation into calculated decision-making. It also forces you to develop genuine conviction. Conviction isn't something you get from reading a headline or following someone else's opinion. It comes from doing the work yourself, building a thesis piece by piece, until you understand exactly why the opportunity exists and why the market might be wrong. When you reach that point, you're not easily shaken by short-term volatility because you know what you're betting on. Many investors dilute their returns because they treat every idea the same. They put small amounts of money into dozens of trades, hoping one or two might work out. That approach rarely produces extraordinary results. If your best ideas only receive the same amount of capital as your average ideas, your portfolio becomes average by design. Great investors understand that not all opportunities are equal. Some trades carry far more potential than others. When you identify those rare situations where the risk-reward relationship is extremely favorable, that's where concentration becomes powerful. By allocating more capital to your strongest ideas, you allow your best insights to drive your performance. This doesn't mean being reckless or ignoring risk. Concentration without discipline can be dangerous. The key is to ensure that every conviction position is supported by deep understanding and controlled risk. When those elements come together, concentration becomes a strategic advantage rather than a gamble. Over time, I noticed that the biggest gains in my career didn't come from hundreds of small trades. They came from a few moments where the market presented an opportunity that was simply too compelling to ignore. In those moments, the decision wasn't about whether to participate, The decision was about how much to commit. Those are the moments that define great investors. They recognize when the odds are dramatically skewed in their favor, and they act decisively. Instead of spreading themselves thin across endless ideas, they channel their energy, research, and capital into the opportunities that truly matter. But none of that focus or conviction matters if you don't survive long enough to let it work. The market has a brutal way of eliminating people who underestimate risk. You can have brilliant ideas, strong research, and perfect timing. But if you fail to protect your capital, one bad decision can erase years of progress in a matter of days. One of the first lessons I internalized was that making money in markets is important, but staying in the game is even more important. Survival isn't exciting. It doesn't create headlines or dramatic stories. Yet it is the foundation of every long-term success story in investing. If you lose too much capital, the math begins to work against you in a cruel way. A 50% loss doesn't require a 50% gain to recover. It requires 100%. That reload should change the way every investor thinks about risk. Protecting capital begins with humility. Markets are larger, smarter, and more unpredictable than any individual participant. No matter how strong your thesis appears, there is always a chance you're wrong. The moment you believe you can't be wrong is usually the moment the market teaches you otherwise. Because of that, discipline becomes non-negotiable. Every position must have a clear understanding of risk before the trade is even placed. Not after things start going wrong, not after losses begin to grow, but before a single dollar is committed. You need to know exactly how to lose if the market proves your idea incorrect. This mindset changes the entire approach to investing. Instead of thinking only about how much money you can make, you begin by asking how much money you could lose. That question forces clarity. It forces you to evaluate whether the potential reward truly justifies the risk being taken. Many investors ignore this step because they are emotionally attached to the upside. They imagine the profits, the perfect scenario where everything works in their favor. What they fail to consider is the possibility that the market might move against them in ways they didn't anticipate. When that happens, fear replaces logic and small losses turn into catastrophic ones. I learned early that cutting losses quickly is not a sign of weakness. It's a sign of professionalism. When a trade clearly isn't working, protecting capital becomes the only priority. Pride has no place in that decision. The market doesn't care about your ego, your analysis, or how confident you felt when you entered the position. There is a powerful psychological shift that happens when you accept this reality. Losses stop feeling like personal failures. They become part of the process. Even the best investors in the world are wrong a significant percentage of the time. The difference is that their losses are controlled while their gains are allowed to grow. Capital protection also means avoiding situations where one trade can destroy everything. Excessive leverage, oversized positions, and emotional decision-making create fragile portfolios. They may look impressive during winning streaks, but they collapse quickly when the environment changes. Markets constantly cycle through periods of stability and chaos. During calm periods, risk often feels invisible. Prices move smoothly, volatility remains low, and investors become comfortable taking larger and larger bets. That comfort is dangerous because it encourages complacency. Then something unexpected happens. A policy shift, a geopolitical shock, a sudden change in economic data, volatility explodes, liquidity disappears, and positions that once seemed safe become incredibly fragile. Investors who ignored risk management suddenly find themselves trapped. Those who survive these moments are the ones who respected risk long before the crisis arrived. They never allowed a single idea to threaten their entire portfolio. They understood that protecting capital is not about avoiding risk entirely, but about controlling it intelligently. When you build your strategy around survival first, something remarkable happens. You gain the ability to stay patient. You're no longer forced in desperate trades just to recover losses. Instead, you maintain the flexibility to wait for the next great opportunity. That patience compounds over time. Each avoided disaster preserves the capital needed to capture future gains, while others are struggling to rebuild after major losses. You remain positioned to take advantage of the next shift in the market landscape. That ability to wait patiently becomes far more powerful when you understand the bigger forces moving the market. Individual stocks, currencies, or commodities might seem like isolated opportunities, but in reality they are often driven by massive economic currents operating beneath the surface. Interest rates, inflation trends, central bank policies, global liquidity, and geopolitical shifts quietly shape the direction of entire markets. Investors who ignore these forces are often reacting to symptoms instead of understanding the underlying cause. Early in my career, I became fascinated with the idea that the largest moves in markets rarely come from small, isolated events. They usually come from macroeconomic shifts that ripple through the entire financial system. When a central bank changes its policy direction, when inflation expectations suddenly rise or collapse, or when global capital begins flowing from one region to another, the effects can be enormous. These shifts create opportunities that are far larger than the day-to-day fluctuations most traders focus on. Studying the macro environment means stepping back from the noise of daily price movements and asking deeper questions. What is happening to global growth? Are interest rates likely to rise or fall? Is liquidity expanding or contracting? Are policymakers stimulating the economy or tightening financial conditions? These questions may sound broad, but their answers shape the behavior of nearly every asset class. For example, when interest rates begin to fall across major economies, the cost of borrowing declines, businesses expand more easily, investors search for higher returns, and capital often flows into equities and risk assets. When rates begin rising aggressively, the opposite tends to happen. Liquidity tightens, risk appetite shrinks, and markets that once surged suddenly face strong headwinds. Understanding these dynamics allows you to position yourself ahead of major market moves, rather than reacting after they happen. Instead of chasing trends that have already begun, you begin to anticipate the conditions that could create them. This shift in thinking transforms investing from term speculation into strategic positioning. Macro analysis also helps explain why certain trades work at particular moments in time. A company might have excellent fundamentals, strong leadership, and impressive growth potential, but if the broader economic environment turns hostile, even great businesses can struggle in the market. On the other hand, when macro conditions are supportive, entire sectors can rise rapidly as capital floods into them. The real edge comes from connecting these macro signals with specific opportunities. If you believe inflation is about to accelerate, certain industries may benefit while others suffer. If global liquidity is expanding dramatically, risk assets might experience powerful rallies. If economic growth slows sharply, defensive assets often attract attention. This perspective also encourages you to watch policymakers closely. Central banks and governments hold enormous influence over financial conditions. A shift in monetary policy can trigger waves of capital movement around the world. Investors who recognize these shifts early often find themselves positioned on the right side of major trends. But macro investing isn't about predicting every economic data point or trying to forecast the future with perfect accuracy. It's about identifying powerful trends that could drive markets for months or even years. Once those trends become clear, the goal is to align your positions with the direction of those forces. There is also a psychological advantage to thinking this way. When you understand the macro narrative behind your trade, you're less likely to panic during short-term volatility. Markets rarely move in straight lines. Even the strongest trends experience temporary reversals. Without a broader framework, those fluctuations can shake confidence and cause investors to abandon good positions too early. By focusing on the macro environment, you begin to see markets as interconnected systems rather than isolated charts and tickers. Currency movements influence commodity prices. Interest rate policies influence stock valuations. Global capital flows reshape entire regions of opportunity. Each piece of the puzzle contributes to a larger story unfolding across the financial world. The more clearly you understand that story, the easier it becomes to recognize when a major opportunity is forming. Instead of reacting emotionally to every headline or market swing, you're observing the gradual buildup of conditions that can eventually trigger dramatic price movements across entire asset classes. Once those conditions begin to align, hesitation becomes the most expensive mistake an investor can make. Markets rarely present perfect opportunities, but there are moments when the balance between risk and reward becomes so favorable that the decision to act should feel almost unavoidable. These moments don't arrive frequently, and when they do, they often appear in the middle of uncertainty when most participants are too cautious or too distracted to recognize what is unfolding. Recognizing an opportunity is only half the battle. Acting on it with conviction is what ultimately creates extraordinary results. Many investors spend enormous amounts of time analyzing markets, reading reports, and studying economic data, yet when the moment finally arrives, they move too slowly or commit too little capital. The opportunity passes, and they are left watching the market move exactly the way they predicted. The difference between average investors and exceptional ones often comes down to how they behave when the odds are clearly in their favor. Average investors become cautious just as the opportunity becomes strongest. Exceptional investors understand that those rare moments are precisely when bold decisions are required. Aggression in markets does not mean recklessness. It means having the confidence to scale into a position when your analysis, the macro environment, and market psychology all point in the same direction. It means recognizing that the purpose of patience was to prepare for this exact moment. After wading through months of mediocre opportunities, the goal is not to remain timid when the right setup finally appears. Think about how probabilities work in any competitive environment. If the odds of success are only slightly in your favor, taking a small position makes sense. But if the odds become overwhelmingly favorable, the logical response is to increase your exposure. The market occasionally offers those situations where the potential reward is many times larger than the possible risk. Those are the moments that can define an entire career. There is also a psychological barrier involved in pressing an advantage. As a position grows and begins generating profits, fear often begins to creep in. Investors start worrying about giving back gains or being embarrassed if the market suddenly reverses. That fear causes them to reduce their exposure just as the trend begins gaining strength. The irony is that markets often reward conviction. When a powerful trend begins, it tends to attract more and more participants. Momentum builds, narratives spread, and capital flows rapidly toward the same direction. Investors who recognize this early and commit aggressively often capture the most explosive portion of the move. Another important factor is timing. Aggression should occur when the thesis is becoming stronger, not weaker. As new information confirms your original idea, confidence should grow. The market may begin validating the position through price movement, increasing volume, or shifting sentiment. Each of these signals can reinforce the belief that an opportunity is unfolding exactly as expected. This is when scaling into a position can become extremely powerful. Instead of committing everything at once, investors can gradually increase their exposure as the probability of success rises. By doing this, they align their capital with the strength of the trend itself. It's also important to recognize that aggressive positioning requires emotional control. Large positions can produce large swings in profit and loss without strong discipline. Those fluctuations can trigger impulsive decisions that damage the original strategy. The key is maintaining clarity about why the position exists in the first place. When the underlying thesis remains intact and the macro forces continue supporting the trade, temporary volatility should not shake conviction. Markets constantly test the confidence of investors, and those tests often appear right before major moves accelerate. The most memorable trades in any investor's career rarely feel comfortable while they are happening. They often involve stepping forward when uncertainty is still present, trusting the research, the analysis, and the understanding built during months of preparation. In those moments, the market rewards courage backed by discipline. and the decision to act decisively transforms a well-researched idea into a position capable of capturing the full power of a major market shift. Yet even the strongest conviction and the boldest positioning cannot eliminate one unavoidable reality. Some trades will simply be wrong. Markets are shaped by millions of participants, unpredictable events, and constantly changing information. No matter how carefully an idea is constructed, there will always be moments when the market moves in a direction that contradicts the original thesis. What separates durable investors from those who disappear is how quickly they recognize that reality and respond to it. Many people believe successful investing is about being right all the time, but the truth is almost the opposite. The real skill lies in recognizing when you are wrong and acting immediately before a small mistake grows into a devastating one. The difficulty is not intellectual. Most investors are capable of recognizing that a trade isn't working. The real challenge is emotional. Admitting a mistake can feel like admitting failure, especially when the position was built on months of research and strong conviction. The human mind naturally searches for reasons to defend the original decision. This is where dangerous habits begin to appear. Investors start explaining away negative signals, convincing themselves that the market simply doesn't understand the opportunity yet. They look for articles, opinions that support their existing belief, while ignoring evidence that contradicts it. Instead of evaluating the situation objectively, they become emotionally attached to the trade. The market punishes that attachment without hesitation. Prices continue moving in the wrong direction, losses begin expanding, and what could have been a manageable setback slowly turns into a major problem. By the time the investor finally accepts the mistake, the damage has already grown far larger than it needed to be. Professional investors develop a very different relationship with mistakes. They treat them as information rather than personal failures. When a position begins behaving in a way that contradicts the original thesis, it becomes a signal that something in the analysis might be incorrect. The fastest way to protect capital is to step aside and recess. Cutting a losing position early can feel uncomfortable in the moment, but it creates a powerful long-term advantage. Small losses are manageable. They leave capital intact and preserve the flexibility needed to pursue better opportunities. Large losses, on the other hand, consume emotional energy, distort decision-making, and restrict future options. There is also a psychological benefit to this discipline. When you know that losses will always be limited, you gain the confidence to pursue opportunities without fear of catastrophic consequences. Each trade becomes part of a broader process rather than a life-defining event. Another critical aspect is speed. Markets move quickly, and hesitation during a losing trade can be extremely expensive. The longer an investor waits to acknowledge a mistake, the more capital is placed at risk. Decisive action prevents the situation from escalating. This does not mean abandoning positions at the first sign of volatility. Markets fluctuate constantly, and even strong trades experience temporary setbacks. The key is distinguishing between normal noise and meaningful evidence that the thesis is breaking down. If the fundamental reason for the trade no longer holds, the correct response is immediate action. Ironically, the willingness to accept mistakes quickly often leads to better decision-making in the future. Each loss provides feedback about how markets behave and how assumptions can fail. Over time, this feedback sharpens judgment and strengthens the ability to recognize stronger opportunities. Investors who refuse to admit mistakes miss this learning process entirely. They remain trapped in a cycle of defending bad decisions rather than improving their understanding of the market. The professionals who endure for decades develop a habit of emotional detachment from individual trades. They focus on the quality of the process rather than the outcome of any single position. If the process identifies an opportunity and the market proves it wrong, the position is closed and attention moves forward to the next possibility. By reacting quickly and without hesitation, they prevent errors from growing into disasters and maintain the freedom to deploy their capital where the probabilities are once again shifting in their favor. That freedom becomes incredibly valuable when a position finally begins moving in the right direction. After navigating the discipline of protecting capital, studying macro forces, acting decisively when opportunities appear, and cutting losses quickly when necessary, the next challenge is far less obvious but just as important. It is the ability to allow success to continue unfolding without interrupting it too soon. Many investors become skilled at finding good ideas and even managing risk, yet they consistently limit their own potential by taking profits too early. The moment a trade begins generating gains, a new form of pressure appears. The fear of losing those profits can become stronger than the desire to let the opportunity fully develop. It is a deeply human reaction. When a position moves into profit, the mind immediately begins calculating what could happen if the market suddenly reverses. Instead of focusing on the original thesis and the larger trend, attention shifts toward protecting the gains already achieved. The temptation to close the trade and lock in a small victory becomes very strong. This instinct might feel responsible, but in many cases it quietly destroys the mathematics of long-term success. If losses are kept small while profits are also kept small, the overall outcome tends to remain mediocre. Truly exceptional performance requires a different balance. Losses must remain controlled, but winning trades must be allowed the space to grow far beyond the size of those losses. The most powerful market moves often develop slowly at first. A position begins working, confidence grows, and gradually more participants recognize the opportunity. As additional capital flows into the same direction, momentum builds. What started as a modest movement can transform into a powerful trend that lasts far longer than most people expect. Investors who exit too early miss the most explosive portion of these moves. They capture a small piece of the opportunity, while the majority of the trend unfolds without them. Later they watch the market continue rising, or falling exactly as their original thesis predicted. But their capital is no longer participating in the move. Allowing winners to run requires a very different mindset from the one used to manage losses. When a trade moves against you, speed and discipline are critical. When a trade moves in your favor, patience becomes the dominant skill. The goal is not to rush toward the exit, but to remain aligned with the forces that created the opportunity in the first place. One way to maintain this patience is by constantly revisiting the underlying thesis. If the macro conditions, market psychology, and fundamental drivers supporting the trade remain intact, then the position may still have significant room to develop. Temporary fluctuations or short-term pullbacks should not automatically trigger an exit. Markets rarely move in straight lines. Even the strongest trends experience corrections that test the confidence of investors. These moments often shake out participants who entered the trade late or who lack conviction in the broader narrative. Those who understand the larger forces at work are better equipped to remain steady during these temporary disruptions. Another useful approach is gradually managing the position rather than closing it entirely at the first sign of profit. Adjusting position size over time allows an investor to protect some gains while still remaining involved in the potential continuation of the trend. This balance keeps the door open for the kind of outsized returns that define great trades. There is also an emotional transformation that occurs when investors learn to trust a winning position. Instead of reacting to every small movement, they begin observing the behavior of the broader market. They watch how other participants respond, how sentiment shifts, and how momentum evolves as the trend strengthens. As the trade continues working, the initial uncertainty fades and the opportunity reveals its full scale. What once looked like a promising idea begins transforming into a major move driven by powerful economic forces and growing participation across the market. In those moments, the discipline to remain patient becomes just as valuable as the courage that originally opened the position, allowing the full weight of the trend to continue building behind the trade while capital remains positioned to capture every additional wave of momentum as the market pushes further and further in the anticipated direction.